was talking about trade balance in the US, the data that we got yesterday afternoon at 1:30, and this I was just showing you the S&P chart and showing you that this had actually created a nice bullish move up to what in the end was the high of the day. But I just wanted to show you the trade balance chart. Here it is for the US, looking back over the last couple of years, and there is a persistent trend in place here. So the trade deficit, so remember the trade balance is looking at the value of products imported relative to the value of products exported for a country, and the US has had a heavily negative reading on this for many years, and this isn't necessarily unhealthy, but the size of their trade deficit, so if you import a lot more than you export, then your trade balance number is negative, and it's called a trade deficit, of course. And so here we've got the US profile actually showing a trade deficit consistently narrowing, consistently dropping and dropping and dropping and dropping. Who's going to tell me why? There's one key reason why. Type in the room. All I need is one word. Thank you guys indeed. Oil, shale gas to be more specific, fracking. These are the words you might have typed in there. This is the shale gas revolution in the US, which is really it's a game changer. So this is ongoing. The increase in oil production in the US has been nothing short of phenomenal. The statistics still coming in pretty amazing. The EIA, which is the Energy Information Association in the US, are predicting that by next year, 2015, oil production in the US should have reached record levels. So oil production in the US peaked in the early 70s, where they managed to produce 9.6 million barrels a day. Ever since then, it's been in decline until the shale gas revolution really kicked off a couple of years back. Now, they reckon next year the production rate should return to 9.6 million barrels per day. Okay, so this is a return to the record high seen in the early 70s, and the boom isn't expected to stop there. So we are expecting by 2016 the US to be producing more oil on a daily basis than they have ever done in their history. Okay, now in terms of the energy dependence of the US, if you go back to 2005, the US imported 60% of their energy needs. By next year, they reckon that figure will be down to just 25%. Okay, so what is changing this trade balance figure so dramatically is that they're importing a lot, and I mean a lot less oil than they used to, because they're producing much more of it themselves. Okay, so this is actually very positive for the US economy in the medium to long term, and they do believe by I don't know, maybe the end of the decade, by 2020, the US may well be self-dependent. They'll be producing all of their oil. And of course, economically, this is phenomenally positive, but it carries a lot more implications than that. If you just think about foreign policy, the US have been so dependent on Middle East and the crude oil produced in that area, but if they don't need it anymore, how's that going to shift foreign policy, and how's that going to change the sort of geopolitical dynamic of this world? So it's quite an interesting development, to say the least, not just for economic reasons. But yesterday, trade balance figures showing a deficit a lot narrower than expected. What we've had off the back of that is the likes of JP Morgan and others upgrading their Q4 GDP forecast for the US. And, we're still seeing some of these big banks coming into 2014 with very bullish projections for the US economy. And so this helped yesterday. Just flick back to the S&P chart here. This certainly helped yesterday to really get the year going. As I said earlier, it's been a bit lethargic this year, a little bit depressed, but finally a positive US session. Now, off the back of this, Asia last night have been nice and bullish as well. We saw a little bit of dollar strength, and This meant that the yen weakened, and we know what happens when the yen weakens. The Nikkei 225 rallies aggressively, so the Nikkei 225 posted almost a 2% up day overnight. Decent session for Chinese stocks as well, really off the back of US positivity, off the back of a strong showing in the peripheral European bond markets. So nice and positive finally. Here today, this morning, we drifted higher during that Asian positive run, but we've just given some of that back at the European Open. Yesterday also we had good data from Germany on employment and also retail sales. But let's have a quick look in at the data for today. Let's have a look at the calendar. So we've got an important figure at 10 o'clock. We're going to get the EU retail sales figure. This is for the month of November. We're expecting retail sales growth of just 0.1% for the month of November. And that we're expecting to be 0.3% higher than November 2012. This is off the back of slightly negative figures that we got for the month of October. So we will see. Oh, the other thing let me talk about Eurozone inflation in a second. That was the data I missed out from yesterday, which is important and possibly carries some pretty big implications for maybe tomorrow or ECB meetings in the next few months. But in terms of data flow today, important data at 10 with the retail sales and unemployment rate from Europe. Important data at 11, factory orders from Germany. And then I would suggest the most important data of the day will be at 1:15, the ADP employment change. Also, later on tonight at 7, well, hang on, we got oil inventory data as well at 3:30, but then at 7 o'clock tonight we will get more detail out of that meeting that the Fed had 3 weeks back where they tapered. So we're going to get the minutes from their meeting that's going to give us a little bit more detail with regards to the discussion that went on that obviously resulted in the conclusion that they would go ahead and taper against market expectations. Okay, but let's look at the ADP chart. This is the figure. Remember, this is private sector job creation on a monthly basis. Sorry, let me just see what the forecast was or is. So it's 195 is what we're forecasting for this year. Cable's just ticking to a new high, by the way, guys. The cable's just made a new high for the day, despite the fact euro-dollar's down around its low, so a real breakdown in that correlation of late, and certainly at the moment. But back to ADP employment in the US. So we're expecting 195,000. So that's a slight drop from last month. Remember, this is for the month of December. So how many jobs were created in the private sector in the month of December? And we're expecting it to be 195,000. The November figure was very bullish, 215,000, which, as you can see, was the best reading since the end of 2012, and paved the way, along with a nice bullish non-farm payrolls number, paved the way for the Fed to go ahead and start tapering that decision announced on the 18th of December. Okay, so this is important data, obviously, and we've got non-farm payrolls coming on Friday, and this will be a nice indicator. Last month this was a really good lead indicator, nice bullish number on the ADP, followed by a nice bullish number on non-farm payroll. So we'll see what we get at 1:15. Let me just pull in the euro-dollar chart here because I want to just touch on what happened yesterday with regards to Eurozone inflation. Let's go to a daily chart, actually. So the inflation figure yesterday for the Eurozone came in at 0.8%, okay, as expected. However, lower than the month before, and really just showing you, well, let me show you the inflation chart. Sorry, one sec, I should have had this up already. Just going to show you the Eurozone inflation chart and we spoke about this yesterday, of course, before the data was announced. Give me a second and I'll bring up this chart. Here we go, inflation rate. So here we are, 3 months in a row of inflation prints below 1%. This is not good. This is deflation risk. Remember, the ECB's inflation target is 2%, and here we are below 1%. So, you know, where's this thing going? Are we going to see inflation continue to track lower? Look at this trend. This downtrend in inflation in the Eurozone is, what, about 15 months old now. And as it stands, there's no sign of it reversing. So if this trend does continue, if in quarter one of this year we see an inflation print below 0.7%, then this may well trigger one of the big monetary policy decisions of this, not only of this year, but of the entire economic crisis, because this may well trigger the ECB into action.